Welcome back to the Hurdle Rate, episode 26. I'm Tim Kotzman. I'm here with Matt Cole, Jeff Walton, and our second ever special guest, Pierre Rochard. We're going to cover a couple topics today, including S&P 500 inclusion or not, a video clip talking about risk, the strategy ATM resuming the dividend, the first dividend on the stretch preferred. And of course, it wouldn't be a great episode without Pierre's Bitcoin treasury viewpoints. So maybe I'll throw it over to Jeff or Matt to jump into your reaction to the S&P and walk through that a little bit.
Sure. Maybe I'll kick it off and then kick it over to Jeff. And so the S&P 500 index is just something that I followed so closely throughout my career. And I've been so negative on not the rules of the S&P 500, but the black box committee, that it was not surprising, unfortunately, for me to see strategy left out for now. I mean, I think it's really more of a matter of when, not if, that they get in. But really the problems with having more than just a rules-based approach to an index. And so, like, why does someone buy an index like a 500 fund? Because they want passive exposure to the market. And when you have a black box committee, and just to give you some information on the committee, no one knows who's on the committee. When they then make a decision, they give you no information about why they made a decision. And so you think about this from the perspective of like someone that's investing in Bitcoin treasury companies, and the authenticity, the amount of information, like Dylan LeClaire, we're going to call our shots. The S&P 500 is exactly the opposite of that. We're not going to call our shots. We're not going to tell you why we did that. We're not going to tell you who made the decision, and you will accept that because that is what it takes to be in or out of the S&P 500. I just think it's a really bad dated setup that maybe made sense historically, but when you think about where we are with data and technology, I think it's very dated. And so for us, when we launched our 500 fund, so we have all these different ETFs, and we have a suite of passively managed equity ETFs, and we made a conscious decision a couple of years ago to not use S&P, and instead we use Bloomberg. And Bloomberg's not the only index provider that's like this, but with Bloomberg's indexes, there is no committee. It's just rules. It's data. And if you pass the data test, you're in. And so as an example, strategy was added to the Bloomberg 500 index last September. And so we're basically 1 year into the strategy being in the Bloomberg 500 index. They're still not in the S&P 500. They just got eligible by their rules. There's a little bit differences in the rules, but even once you pass the rules, you have to pass the committee. And I just think it tends to lead to bad decisions. Most innovative companies. It led to a bad decision with Tesla back in the day. It's now strategy. I think at one point it was Microsoft that got left out for a little bit. And so it's not even necessarily, it could be, biases for political reasons or uncomfortableness around Bitcoin. We'll never know because they'll never tell us. But I think anytime you have a new company that's doing interesting things, by definition, that'll be scary. And I think that when you put humans in, it tends to have them pessimistic to follow the rules that they've set forth, and I think that's what's happened here. And I think it's too bad for S&P 500 holders for now.
Yeah, humans are naturally biased. If you include, computers and algorithmic models for inclusion, it just removes any potential bias and it moves forward on that basis. So I've been also watching this incredibly closely for roughly the last 400 trading days, and strategy being potentially included in the S&P 500. So back in February of last year, they breached the market cap threshold of around $14 billion to be included in the S&P 500. And now we're looking at them trading around a $96 billion market cap. So they're significantly over the market cap threshold to potentially be included. Now, to your point, Matt, one thing that's really interesting that I think a lot of the community and people don't really understand with strategy here is if they were to have adopted FASB fair value accounting last year when they were able to, they would have qualified for the S&P 500 for the first time at the end of Q3, so October 30th, 2025. So that's, I think, likely why the Bloomberg 500 would have included them, because some assumption on adopting FASB fair value accounting and the value of the assets on the balance sheet being qualified as earnings would have counted at that point. So you could take the perspective that they've been excluded from the S&P 500 now for, what is this, 3 or 4 different inclusion periods. And this isn't necessarily just the first, even though it's the first technical after the FASB fair value accounting adoption. So a little bit of a nuance there. I wasn't expecting them to necessarily get included on their first go around. A lot of these companies with their first go around, they've been excluded, like Robinhood and AppLovin historically. I think they qualified a couple of quarters ago and now they're getting included. So it seems like as a company qualifies, there's some deliberation back and forth about probably volatility, business viability, et cetera, and just understanding bureaucracy of these rating agencies and these environments. I can understand a lot of these things probably being a little bit less top of mind. Like everybody that's following this incredibly closely thinks that strategy should be included because it's like the primary thing that Bitcoiners and Bitcoin equity holders are focused on. But it's not the primary thing that these rating agencies are focused on. And they've got a lot of other things on their plate to review and go through, which is just a bureaucracy process that takes quarters to churn through. So I'm not incredibly surprised. I'm bullish for the horizon, but we'll see how this goes.
It sort of reminds me of what happened at the LIBOR scandal. Not accusing S&P of any kind of fraud, but just that whenever you have discretion, human discretion, combined with lots of people relying on it, I think that's the real paradox here is you have all these passive investors relying on an index that's actively managed. That they are making discretionary decisions about what gets included or not. To steelman their perspective, perhaps as Jeff mentioned, it's about the volatility, which is that they could look at strategy today and say, okay, well, they qualify, but because of Bitcoin's volatility, we feel like they might not qualify next quarter or the quarter after that. And so maybe they don't want to have churn in the index at the margin that drives, makes things worse, right? Worsens the quality of the index, perhaps. But that's still a judgment call. And I think that if investors truly want to be passive, they would want to really have a rules-based approach to their index.
Or if you want the rules, then put volatility as a measure for the rules. It's actually a solvable problem, but when it's subjective, I think that leads to the problem, and then the question becomes, well, if it's a quasi-active fund, have they made good decisions for shareholders from a returns perspective or bad decisions historically? And historically, it's been mostly bad decisions, actually. And so the rules-based approach outperforms. And I'm not a strong believer in the efficient market hypothesis, but people that are strong believers would point to that and say, remove the people. The people are not adding value here. And so it's super interesting. I guess curious to your guys' perspective if you have a guess on when they get in. I think it'll be within the next 6 months, but we'll see.
I think at some point it'll be a little bit undeniable. Like the company would be so big, similar to Tesla, right? Tesla, I think when they first qualified for inclusion, I think it was around $150 billion market cap, and then it ballooned to $600 billion market cap, and it's like, oh my God, we have to put this company in. It's such a huge component of the index now that we kind of have to put it in. So, yeah, Pierre, thoughts?
Well, perhaps you're right. Perhaps the success of the business model really causes some degree of backlash. We saw NASDAQ come out with some. It seems like they're going to come out with some new rules or some new instructions to companies adopting this business model to really, charitably, they want consent from the shareholders, which I think is good governance. Uncharitably, they are trying to create essentially capital controls, and they're trying to prevent dollars from going into Bitcoin, and that they will potentially get more aggressive as they see more success in the Bitcoin treasury space, that they want to gatekeep that. So whether it's in the form of the S&P 500 or listing rules or other mechanisms of soft power that they find to try to contain this phenomenon, which we see the value of it and we see how it creates value for shareholders, but others within capital markets don't have that view. And I like the Jim Chanoses of the world who they disagree with us, and so they go short the stock and long Bitcoin, and they've got their approach to it. I really question the soft power approach of trying to put up additional rules for Bitcoin treasury companies just because you're bearish on them, right? Go start a hedge fund if you want to have skin in the game and put money where your mouth is.
I think one thing I just want to add for clarity and perspective on this whole situation. One of the reasons that we're talking about this, and this is so important, is the S&P 500 makes up 3 of the 5 largest index ETFs on the planet. It's the largest passive index fund on the planet where a ton of capital is being flowed into. So this is a really huge deal. I think some statistic like 60 or 70% of the entire stock market is a function of these passive index ETFs, with the S&P 500 being the largest one. I think it's been around since like the 70s. And now we've got newer rules-based indices that are coming up and becoming a little bit more popular, catching some steam here, like NASDAQ 100, as it captures a little more of this faster moving environment with AI and tech and innovation. So it'll be interesting to see if there's any, landslide shift in capital from S&P 500, or if they lose dominance. And I think that's something to watch over the next couple of decades.
Maybe a couple points on the NASDAQ issue you brought up here, because I think that is super interesting, and also to your point, gives me concern about capital controls and reducing pre-market activity. I think it's still a work in process about what it means, but you saw Strategy already come out and say this won't impact their business model. And my initial read on it, and to be clear, I don't agree with it, is that I think it will be potentially most difficult for newer Bitcoin treasury or broader digital asset treasury companies that don't have an operating business around them, number one. And then obviously like getting shareholder approval. To me, that's something that, is just good governance, generally speaking. I mean, I think if the shareholders don't want you to buy a bunch of Bitcoin, that's who you're ultimately in service of. But I don't think that should be a constraint for really anybody. But I do think that there was something in there that might be worth, that I think more clarity will come out on of for some of the newer players of, do you need an operating business, or how you need it defined. And I think that ultimately, if it's an overreach, will create hopefully competition amongst the exchanges. I mean, you haven't seen the New York Stock Exchange come out against any of that yet. And so it's one of those issues where if it's not the law and it's an exchange going beyond the law, which you've seen from exchanges before. So like as an example, NASDAQ a few years ago put in place diversity requirements on their board that was in excess of the law. So they have implemented, capital constraints based on their viewpoints of what governance needs to look like before. And I think generally speaking, in almost every single instance, let the market speak. And if people are doing something that doesn't make sense, as an example, something I don't think makes sense is, and we've spoken about this a lot, is Ethereum treasury companies. I think their house is built on sand, but I don't think they should be blocked from existing. I think they should be able to go out there in the market. People that want to invest in them should be able to invest, and they succeed or they fail on their own merits, not because, someone like myself thinks that their house is built on sand, destined to not work out over the long run. That's not my role in capital markets. I don't think it should be the exchange's roles either.
If you look over the last 5 years, Microsoft surrendered $200 billion of capital. They literally won it. How many companies on earth ever generated $200 billion in after-tax cash flow? Right? It's got to be one of the 10 greatest achievements ever. They won, and they snatched defeat from the jaws of victory. They took the money, and what did they do with it? Give it away. What are we really doing? Well, we're dividending it out. That's one way to get away, and we'll buy our stock back. That's another way to give it away. What happens when you do that? you amplify the risk factors in your own prospectus for your own shareholders. You're now facing these are actual risks that Microsoft publishes to the world. These are the risks that the world's greatest company takes. Every investor has to assume these risks if they want to use Microsoft stock as a long-term store of value. What Microsoft did was they made sure they had $200 billion less capital to deal with the risks, and they probably decreased their enterprise value dramatically. So you're actually levering the company on the future risk. How do you escape the vicious cycle? When you get that much risk, you know what you do? You put massive pressure on your employees. Then you put massive pressure on your customers. Then you force your customers to buy products for 3 years when they only want 1 year. You force them to buy everything when they only want some things. And you lever your competitors. They complain to the regulators and the politicians. You get sued. Everybody gets angry. Then you go and you engage in the political process. It's a very divisive, stressful dynamic. And if you were to sit in the boardroom of Microsoft and say, well, why do you have to force everyone to sign a 3-year contract or whatever? The answer is because we get a lot of risk. We're trying to strip the volatility off of the earnings forecast for 12 months from now. Well, Bitcoin is the asset without that counterparty risk. You want to get away from counterparty risk to competitors, countries, corporations, creditors, currencies, or cultures. You got to find something that's not exposed to any of them. And that's Bitcoin. So, if you could buy a $100 billion company growing 60% a year at 1 times revenue, and if it was more profitable than your own company, would you do it? Of course you would. What if you could do it every year? Forever. Right? Bitcoin is the universal, perpetual, profitable merger partner.
It's a great clip. I mean, Saylor's coming out and just directly reframing the world of risk, right? You've got all of these risks on your balance sheet, and I really love this framework of identifying risks as like a number. These are all what am I trying to say here? They're all like they're quantifiable to some regard, but it's uncertain what those are. And you have this pile of capital and cash to deal with those potential risks down the road into the future. And you just made $200 billion. And what'd you do? You won the game. And what'd you do? You just gave away the capital. And you now have a perpetual merger partner where you can effectively buy a company, thinking of Bitcoin, buy a company that's growing at 60% ARR and put that on your balance sheet. And that is your risk diversifier. That is your capital base to help you manage those future risks down the road. And this is a shift in thinking of using a capital and collateral balance sheet to manage future risk that didn't exist before. And Matt, I think you explained this really well.
Yeah, maybe just to get into this. So if you think about the world pre-Bitcoin, what Microsoft was doing actually makes sense. That you earn profit, you distribute it to shareholders, and why it gets into the fundamental purpose for a corporation, which is what we've been talking about at Strive since day one. That's been like our focus point of our mission. What is the purpose of a for-profit corporation? And the purpose is to maximize shareholder value over the long run in pursuit of your mission. So a mission-focused company. Well, what is Microsoft's mission? Their mission is to empower every person and every organization on the planet to achieve more. So if you're thinking as the CEO or the board of directors of Microsoft, how do I empower every person, every organization to achieve more and maximize value while I do so? I think it's undeniable that if you strengthen the balance sheet, and do so in a way that actually is generating returns, which Bitcoin can do on par or greater than the actual returns of Microsoft, then you are better able to achieve your mission while maximizing value for shareholders. And so I think it's a framework that requires an adjustment to how you think about balance sheet and what you can put about the balance sheet in, which a hard asset that Bitcoin is reintroduces a savings vehicle that we've just been without for decades. And so cash is basically a game of hot potato. You get cash in, you want to get rid of it because it's being devalued, it loses purchasing power. And so as an overall organization, you own too much cash and you're going to trade like a stable coin. And I've joked that that's what GameStop has done to date when they've bought so much cash on their balance sheet that it actually reduces the volatility of the stock. And so you don't want to do that. You want to own minimal stock or minimal cash. It makes sense. And so for what Saylor's calling out is you're leveraging your risk to these risk profiles right at the start of an AI boom, which might be a great opportunity for Microsoft, but it's also a risk for every single corporation to be disrupted in a major way. And they could really reduce that risk for shareholders by putting a lot of cash or a lot of Bitcoin on the balance sheet. So that's my view of it.
I completely agree. I mean, to me, it seems like if they're giving the cash back to the shareholders in the form of buybacks and dividends, it really means that they've turned into a utility, right? It's not a growth stock anymore. It's barely a value stock anymore. It's just a piece of unchanging infrastructure that's going to throw off a regular dividend. But that seems unmatched to the fundamentals of the business, which is that it can be disrupted at any moment. If you have a true utility like a natural monopoly, whether it's electricity or water or something like that, where that's not going to get disrupted overnight. But with the technology business model like Microsoft, you need to have cash on the balance sheet in order to match the future uncertainty of opportunities that are going to arise or challenges that they're going to have to work through. And if they have given back all the capital to the shareholders, they've essentially told their shareholders, go invest in NVIDIA because we can't maximize value for you. So you have to go find a different management team to maximize value for you. And that really seems unprecedented in capitalism and not particularly healthy if we want to have thriving markets where what it turns into, I think, is greater dominance for number one, right? The moat between number one and number two just increases so much because number two says, hey, we're going to give cash back to our shareholders and y'all can go buy number one. And that if we want to have competitive markets, we need to have companies that are well capitalized so that they can compete against each other.
Yeah, I've been really rethinking this landscape of risk around this concept and around fixed income, around equity risk, and trying to wrap my head around like the magnitude of this mispricing of risk from a Bitcoin lens. Like if you are taking this pure fundamental view that Bitcoin is capital, Bitcoin is collateral, your whole worldview shifts in seeing risk in a completely different way. And just looking on that list that Saylor pointed out, here are some risks that Bitcoin doesn't have. Tariffs, physical risk and natural disaster risk, competition, IP, supply chain, cloud adoption, talent risk, hardware risk. All of those risks are things that Microsoft and all of the other Mag 7 have in their risk profile, where if they have Bitcoin on their balance sheet or some sort of, if they've got Bitcoin as a digital asset capital on the balance sheet, you mitigate those risks. You now have more capital to if those risks did hit you. And at some point they will. There is some probabilistic scenario that you're going to be impacted by these risks. It might be this year, it might be 10 years from now, it might be 20 years from now. But you're better off having capital on your balance sheet to mitigate those risks, especially if you're a shareholder thinking long term as a store of value. Again, what's the point of holding any equity? It's a long-term store of value. And I've been thinking about this from Jordy Visser's perspective as well. He's got, I just watched a video earlier this morning, and he says if you're not talking about AI on a podcast, turn it off. Like they're not at the forefront of what's happening. So here I am talking about AI. So one thing that's really interesting in this same risk framework, thinking about AI and the development of where it's going, you've got all of these different AI models run by different companies as well that are all coming to the scene. They're all competing for the same eyeballs, that are all competing for the same future. You've got Perplexity, ChatGPT, Claude, Grok, all of these different AI systems, all competing for energy, all competing for bandwidth. And then you also have these competitors in different regions and different countries as well that are also willing to price their AI at a lower price and take a loss, recognizing the long-term dominance here. And there's going to be this massive competition on pricing of these different things and development of these things that is going to continue to evolve. So it will be interesting to see if these, very large PE ratios of the Mag 7 continue to hold as they are all, chopping at the same pool of capital. Meanwhile, there are companies that are adding, this insurance, you can say, to their balance sheet via Bitcoin to withstand any future volatility in changing evaluation of markets.
The best thing about that is insurance is it actually makes you money.
It's insurance that makes you money. Yeah. It's self-insurance. Bitcoin is self-insurance. And that's
And that's true for the individual too. I mean, that's the whole reason, the whole argument for self-custody of Bitcoin is taking control of your financial future, your financial freedom, self-insurance. It's just, and it's on the corporate level doing the same thing and positioning yourself to be sovereign and control of your own future, reducing your risk factors and not just reducing them, but to take an offensive approach into those risk factors.
I sleep so well at night knowing that I have cold storage Bitcoin.
Oh my gosh. Like people, the funniest thing is when you talk to people that aren't Bitcoiners, you're like, how do you handle the volatility? It's like, I would not sleep well at night if I didn't have Bitcoin. Anyways, but that's where you have to have conviction in it. Otherwise, you just can't handle the volatility. And that's where I've seen people that don't do well on Bitcoin, the people that don't understand it, that are trying to rely on someone else's conviction versus your own conviction. It's very hard to manage a volatile asset without your own conviction in the future, which is why still to this day, education about Bitcoin, about fiat currency debasement, all those different things is so important and so important for this industry to drive forward.
A week ago, I was helping a friend set up his hardware wallet. And as some in our audience might know, there's a seed plate that you can set up that's made of metal that took him aback because he's more of a hard money kind of guy with gold and silver. And so seeing that you still have metal with Bitcoin that can withstand the test of time, that was eye-opening to him. And I think that ultimately getting that kind of hands-on experience of directly tapping into this new monetary backbone yourself is enlightening and goes even beyond just reading a book or listening to a podcast because of how interactive it is. And putting down 12 or 24 seed words into metal, it's unlike any other activity one might engage in, day-to-day life. So I think that getting the risk factors down to a level where you don't even have to worry about fire or flood anymore, that is really astonishing. And then, of course, the decentralization of the network itself, that you're not tied down to a particular geography, a time zone. The weekends, it's still open. And then the open source part of it, where people might view Bitcoin as digital gold, but I think that misses the fact that Bitcoin itself, if you look at the network and the software that runs it, it has actually had upgrades over the years. And so it does continue to get better. And I think that goes to what approach do you have? Do you have a value investor's mindset of looking at the fundamentals of the asset and then looking at what's going on with the market price? Or do you have kind of a technical trader mindset of looking at the Bitcoin price exclusively and not really thinking about the fundamentals at all because you're doing things short term? And so I think that for those who are looking at it long term and doing kind of the bottom up research of what is Bitcoin and before looking at a price chart, probably come out ahead and set up a dollar cost average and make sure that you're always stacking sats, and that way you don't have to worry about whether you're buying the top or not because you're looking at it multi-decade because Bitcoin's going to be around forever. And so I think that that's at the individual level applies. And of course, at the corporate level applies. Even, I would argue, perhaps even more so, because a corporation is meant to last forever as well. And so there's an interesting matchup between Bitcoin's ambition to endure forever. And from a technical perspective, despite all the FUD about quantum and all this, I think that that's going to get addressed over time, and people will look back on it and kind of scratch their heads as to why they didn't buy because of that FUD. But the Bitcoin's going to exist forever, and that the companies that are capitalizing themselves on Bitcoin are going to have a very long life as well.
Value. These companies are storing value.
Yeah.
And I did a little research on like .com bubble with Blow Off Top. And one thing that was, I wanted to know what happened afterwards. And there was this huge shift from technology into value companies, basically companies that had capital. And there were a ton of M&A acquisitions that the companies that had capital had the ability to pick up companies cheaply and move forward and into this new future. So I could foresee something similar happening today where the companies that have the most value are positioned the best. I mean, thinking Berkshire Hathaway, why are they sitting on $300 billion of cash? I don't know. Maybe they think there's some opportunity on the horizon of being able to deploy this capital in any one direction. And I think Bitcoin companies are positioned really well from that perspective as well.
Yeah, I know we want to cover strategy resuming the ATM, and we talk about Bitcoin as self-insurance. We talk about reinsurance. We talk about insurance. One tidbit that Saylor shared during his keynote just an hour ago here in New York was that 5 years ago, when they first put Bitcoin on their balance sheet, their D&O insurer dropped them. So he had to insure his company for D&O, and it took 5 years to turn that around. So obviously that was misunderstood. Now it's understood in a different light. Is there any parallel between that and people viewing the capital markets, the ATM, as at all or largely really influencing anything? Does that make any sense, Jeff?
Yeah, the insurance markets are interesting. They're also a function of political regime as well. And I think that a lot of the hesitancy in the insurance market was probably because of the SEC regulatory environment, crypto. A lot of it was new, and the insurance market is generally years behind like the finance market. I think fintech came out in the early 2000s. Insurtech didn't really become a thing until like 2010. So insurance is generally like a decade behind, and I think they're in a very similar place today. And it just takes the insurance market is just relatively conservative, as you would imagine, and they're not interested in taking on these tail risks. Basically, you both sides have to be willing to pay for the risk and accept the risk. And you've got one side strategy over here saying, look, this risk is incredibly low because I'm just buying an asset that's compounding 60% annually. And the insurance companies say, this is crazy. I'm going to charge you an arm and a leg for it. And there's just a disconnect. Like they're not willing to pay for the coverage. And you know what I mean?
And with the new business model, I think that for the risk essentially comes down to litigation. And I think that in the positive form, shareholders or former shareholders engaging in litigation might be a way of last resort to hold a management team or a board accountable. But in the negative form, it can kind of look more like ambulance chasing, or perhaps even unsophisticated people who didn't understand what the business was doing and invested anyway without looking through the 10Ks, the 10Qs, all these disclosures that are explaining all the different risks and what the business model is. And then when they lose value, they turn to the courts rather than holding themselves accountable for the decisions that they made. And then, of course, the other challenge is what time horizon do people have? I think that for a corporation, the objective has to be long-term, durable value creation. And that some people might be looking at it more short-term, and that creates a conflict. And it creates a lack of expectations alignment between the company and some more short-term traders. And so I think that that can lead to litigation as well, which then impacts, okay, well, for the insurance, how much are we going to charge for premiums because we don't really know what the exposure is in terms of the liability. And then, of course, kind of the general discomfort, if you think about zooming out, Bitcoin as collateral. Essentially here, the Bitcoin is, the insurer on DNO is in some proxy way having to underwrite Bitcoin as an asset, and that they might not be comfortable with doing that, when it's got a 7-year tail or something like that, where they might not know if Bitcoin is going to be around in 7 years. So it's understandable, but as the insurance industry gets to understand Bitcoin more and understand the fundamentals of, yes, Bitcoin will continue to be around, and yes, more than likely than not, it's going to increase in value, and these business models are not all that risky, then it completely changes the calculus for them in terms of growing their business.
Litigation leeches are hard to quantify.
As fiat systems falter, wealth preservation isn't a strategy, it's survival. While the world reacts, Swan Private clients are already prepared. Swan Private builds strong relationships with clients around mutual conviction in Bitcoin's long-term promise. With concierge service, deep expertise, and airtight security, the Swan Private team helps build generational wealth the right way. Swan Private's comprehensive Bitcoin wealth platform serves over 5,000 clients with more than $4.5 billion of Bitcoin purchased to cold storage. Swan Private is built for long-term partnerships. Get started today at swan.com/private. Jeff, do you want to jump into the landscape of the ATMs as you see them? Like, what's the reality here?
Yeah, I mean, thinking back to what the video that we just played here, right? If you're thinking about long-term value creation, or tying all of this together, strategy is back on the common stock ATM. They are continuing to build this, stalwart balance sheet that is indestructible to be able to operate into the future. And they're raising equity at a premium to put them in a great position once the price of Bitcoin continues to run, right? If the price of Bitcoin doubles from here, you go from a company with $70 billion of capital in their balance sheet to $140 billion. You're able to now leverage like $30 or $40 billion to buy more Bitcoin. It's the whole thing is reflexive. So which improves the prefs and the collateral. Pass it over to Matt.
It gets me back to the biggest risk I see with strategy is the exact opposite risk that you see from almost everybody else talking about. It's not, in my view, that they blow up. When you actually look at traditional fixed income metrics, they should be AAA debt. Now that Bitcoin going up actually accounts for GAAP FASB earnings, they are AAA debt. When you look at this on a long-term basis and you just take the time out and you smooth it over the course of a few years. So if you view them as AAA debt, then the biggest risk is not that they fell. It's actually just that it's going to be really hard to get the leverage they want to get on because they have so much Bitcoin and Bitcoin's going up so much. And when Bitcoin goes up, Bitcoin going up actually delevers them. And so it's actually hard. The hardest thing for them, in my view, is to actually get the amount of leverage they want. That's not a scenario about them failing. It just shows you the strength of their balance sheet that people to this day still don't fully understand.
On that note, the way to get access to leverage at scale would be a credit rating. And if S&P is not adding them to the 500 index, that also might be an indication that they would not rate them AAA or as close to reality as they ought to. And so it's interesting that there's a linkage there, but I'm sure both sides of the house are firewalled.
Yeah,
so much
I'm
work
sure
to be
they-
done.
Firewall. I'm sure just like how the consulting side of the business is firewalled. But I think you're right. I mean, they're not going to rate them AAA. It's going to be a hard thing just to get them to be rated, right? And hopefully it's rated investment grade. I know that's the push that broadly that we've talked about, but they are an archaic agency themselves. That it's not all just political reasons. They move very slowly, and there's conflicts there too, but they move slowly. So they'll start being rated too low. And I think the viewpoint that they're AAA rated is more of a viewpoint that if you're comfortable to underwrite Bitcoin as risk from a credit perspective, and you can get comfortable with that, you should love Bitcoin-backed structured Bitcoin instruments as risk income that is mispriced and will likely be mispriced. Yeah, I don't have a call that they'll be AAA rated officially for probably a decade or two. And so that just means that there's a lot of carry. There's a lot of income for income investors that could be generated while that mispricing continues, as long as you're comfortable to underwrite Bitcoin risk.
A decade or two, that's the entire Bitcoin gold rush right there, 21 years.
Exactly.
Kind of funny, right? Numerology at its best.
Pierre, any closing thoughts as our guest?
Yeah, well, to your point about it's a long-term thesis, and so I think that when people look at Bitcoin treasury companies and they look at the spot Bitcoin price, they need to be thinking about it long-term as well. And so it's been interesting to see over the past 6 months as Bitcoin has basically gone sideways, with some runs up to hit all new time highs, but broadly speaking, in the 100 to 120 range, that there's been a lot of folks who are essentially losing steam and feeling like the bull runs over. And I think that's really short-sighted. I think that you've got to look at Bitcoin over at least a 5-year period, and that's how you should approach it. And so I always like to tell people zoom out, and that we're very early in terms of Bitcoin's adoption.
Interest rates dropping on the horizon and people capitalizing on their AI gains. They're going to look for a place to park it. I've got a couple ideas.
Zoom out. Those are always good words to close on.
Yeah. Zoom out. We're early. Awesome. Well, thank you everyone for listening and watching The Hurdle Rate, episode 26. For Matt, Jeff, and Pierre Rochard, I'm Tim Kotzman. We'll see you next week.